Hey, what's up everybody? This is Jessie with Minimalist Accounting and I have an awesome video for you guys today on subsequent events. We will begin our lesson by first defining a subsequent event. Then we will look at the two categories that fall under it. We have case 1 when the condition existed at the financial statement date and case 2 when the condition did not exist at the financial statement date. Finally, we will wrap it up with a few quick and easy examples. First, the definition. A subsequent event is an event that occurs after the date of the financial statements but before the statements are issued. Let's dive into that a little. Let's say we have a timeline and say the financial statement is to be presented for a period ending December 31st, year 1, making it the cutoff date. Now, as an accountant, you will take the next few months to prepare that financial statement before issuing it on, say, April 13th, year 2. Now, a subsequent event is any event that occurs after the date of the financial statements but before the statements are issued, aka any time in this gray area. Now, there are two ways that a subsequent event can present itself. Scenario 1 is when the condition leading to the subsequent event existed at the financial statement date, and scenario 2 is when the condition leading to the subsequent event did not exist at the financial statement date. Now, in scenario 1, because the condition already existed, we are going to recognize that gain or loss in our financial statements and make a note disclosure about it. That makes sense, right? So say our financial statement is being presented for year 1, and if the condition did already exist in year 1, the right thing to do would be to include that amount of gain or loss in our financial statement. In our second scenario, since the condition did not exist at the financial statement date, we will only disclose the event in our notes for completeness. Allow me to illustrate this with an example. Say a loss on an uncollectible accounts receivable as a result of customers' declared bankruptcy due to deteriorating financial condition subsequent to the balance sheet date has occurred. So what's our subsequent event? Well, we have a loss, which occurred subsequent to the balance sheet date because of a customer's declared bankruptcy. But what is the condition? It's the customer's deteriorating financial condition. So we ask ourselves the question, did this condition exist before the balance sheet date? And the answer is yes. This was not a sudden event, it was deteriorating. So we're going to go ahead and recognize and disclose this information in our financial statements. Now let's contrast this with another example where the loss occurred as a result of a customer's major casualty such as fire or flood subsequent to the balance sheet date. Again, there was a subsequent event that occurred, we had a loss, but the condition leading to that subsequent event was a result of fire or flood. Now, did this condition exist before balance sheet date? No, it did not. This was a sudden event. This was not something that could have been predicted. So we're just going to go ahead and disclose this information because this occurred subsequent to the balance sheet date. In conclusion, remember the definition for a subsequent event and ask yourself the question, did the condition exist before the balance sheet date? If your answer is yes, you're going to recognize and disclose that information. But if the answer is no, we're only going to disclose that information in our financial statement. I say balance sheet date up here, but I mean financial statements in general. Just an FYI. Well, anyways, that's it folks. Keep up the awesome work and I'll see you in the next video. Till then, happy counting!